Hey, let's lock in for a minute. Seriously, put your phone down, close those extra tabs. I want your full attention because what I'm about to break down could completely change how you see what's happening in the silver market right now. This isn't speculation. It's not a theory. It's real action from one of the world's biggest economies action, so serious that regulators had to step in with emergency measures. And if you don't understand what this move really means, you're going to miss the loudest signal the precious metals market has sent in over 10 years. Right now, silver is trading around $85 an ounce. Gold's sitting just under $5,000. But here's the thing. These prices aren't the ceiling. They're not even close to fair value. They're the battleground where control is being fought over in real time. Because while most of us are just watching charts, something unprecedented happened. Without warning, the Chinese government shut down 5 different commodity funds in a single trading day. Not for a few minutes, a full trading suspension. Their only silver futures fund available to mainland investors was locked down for the entire day. 4 oil-focused funds were frozen at the same time until further notice. This wasn't maintenance. It wasn't a glitch. It was an emergency response to what regulators openly called systemic risk and imminent massive investor losses. And here's what makes this different. This was the second emergency shutdown in just 8 days. Whatever they thought they fixed on January 22nd clearly didn't hold. The problem came back so hard they had to hit the brakes again. When the world's second largest economy starts triggering emergency trading halts because commodity demand is spiraling out of control, you can't just shrug it off as regulators doing regulator things. This isn't China being China. What's happening there is a direct reflection of pressure building up everywhere, and that pressure is about to spill over into new places. I'm going to walk you through exactly where that pressure is headed, and more importantly, how you can position yourself before the next phase kicks off. But first, if this kind of straight-to-the-point breakdown is giving you clarity you're not finding anywhere else, tap that like button so more people can see it. And subscribe if you haven't already, because what's coming in February is going to separate those who are prepared from those who get blindsided. Okay, let's rewind. On January 30th, Chinese authorities executed what can only be called a coordinated emergency suspension across multiple commodity investment funds. The biggest target was the UBSSDIC Silver Futures Fund. This isn't some small-time product. It's the only public fund in all of mainland China that lets people invest directly in silver futures. Think about that. 1.4 billion people, and this is their one regulated option for silver futures exposure. And it got shut down for a full trading day. That's not routine market management. That's panic containment. And it gets worse. At the exact same time, 4 oil-focused funds were hit with synchronized suspensions. When regulators move on multiple funds across different commodities all at once, they're not dealing with a small isolated issue. They're facing a systemic breakdown. So what broke? What forced their hand? Premiums. Specifically, the gap between what investors were paying for fund shares and what the underlying assets were actually worth. And the numbers are just wild. The UBSSDIC Silver Futures Fund was trading at a 36% premium to its net asset value. Let me say that again. Investors were paying 36% more than the actual silver futures were worth just to get exposure through that fund. What does that mean in real life? If you bought shares at that premium and silver futures didn't move at all, you'd still be looking at an immediate 36% loss the moment that premium normalized. You weren't buying silver, you were buying desperation. You were buying FOMO at any price. Chinese retail investors were so desperate to get into silver, they were willing to pay more than a third extra just to get in the door. They weren't asking what silver was worth. They were asking how fast they could get in before it ran away from them. Regulators saw exactly where that was headed. They watched retail money piling in at mathematically unsustainable prices. They saw the feedback loop forming. Premium rises, people take it as confirmation, more buyers rush in, premium rises again. That's the spiral they decided to stop before it burned the entire retail investor base. Not because they hate metals, not because they're trying to kill the rally, but because when that premium collapses, and it always does, those losses would be catastrophic for millions of people who didn't even understand what they were buying. Now, here's the question almost nobody in the financial media is asking. Why was demand that extreme in the first place? Why were investors willing to pay 36% premiums instead of just waiting? Because the answer shows exactly where we are in this cycle. Silver has been on an absolute tear. In the last 30 days alone, it surged 58%. Not 5%, not 15%, 58%. We're talking about prices pushing toward levels that would have sounded delusional just 6 months ago. Gold's been running hot too, up 22% and approaching $5,600 an ounce. Oil broke resistance, with Brent hitting 5-month highs above $70 a barrel. That's not random. That's not sector rotation. That's a coordinated stampede into hard assets driven by forces that are accelerating, not cooling down. First, monetary policy chaos. Central banks have been whipsawing markets between cuts are coming and higher for longer. Every time traders price in easier money, the dollar weakens, real yields drop, and metals catch a bid. Every time hawkish comments return, we get violent pullbacks. That back and forth creates extreme volatility, and leveraged funds amplify it. Second, geopolitics. U.S. naval movements near Iranian waters, tensions across multiple regions, vulnerable supply chains. When traders start pricing conflict risk into oil, and investors start hedging currency debasement with metals, demand surges fast enough to overwhelm normal market infrastructure. Third, the structural supply crisis. Silver isn't just a monetary metal, it's industrial muscle. Solar panels use it. EVs use it. 5G infrastructure uses it. The green transition is silver intensive, and supply hasn't kept up with demand growth. When monetary demand, safe haven demand, and industrial demand all hit at once, you don't get calm price discovery, you get violent moves. And when all that demand is funneled through one single vehicle serving 1.4 billion people, you get 36% premiums and emergency halts. Now, I want to show you this isn't just a China story. The gold-silver ratio, how many ounces of silver it takes to buy 1 ounce of gold, has compressed to its lowest level since 2011. That's not happening because gold is collapsing. It's happening because silver is catching up hard. And historically, that kind of compression signals a major regime shift. At the same time, physical silver demand has been exploding globally. One major dealer reported a 158% increase in sales of 1 ounce silver coins and a 550% jump in demand for 1 kilo bars over the same period. Google searches for how to buy silver and buy silver online spiked 250% in recent months. That's not niche interest, that's a mass awakening. So when Chinese regulators shut down their only silver futures fund, that demand doesn't just vanish, it redirects. Some flows into physical silver, some moves into Hong Kong listed products, some shifts into gold, some finds pressure points in international markets. This is the critical point everyone misses. The halt didn't kill demand, it forced demand to find new routes, and every new route creates more pressure on global supply chains that are already stretched thin. Now, here's the smoking gun that proves the bigger setup. Normally, if a market gets halted or spooked, shorts swarm in. Funds smell blood. Algorithms pile in. Borrow demand spikes. Borrow costs rise. But right now, the borrow fee for SLV, the world's largest silver ETF, is basically zero. Rock bottom. And there are millions of shares available to borrow just sitting there. Nobody wants them. Nobody's shorting. Do you realize how insane that is? China just triggered emergency halts. The narrative should be, the rally is done, regulators are shutting it down, the trade is crowded, and yet the smart money refuses to bet against it. Why? Because they're looking at the same data we just walked through. The 58% move in 30 days, the physical demand explosion, the structural supply deficit, Chinese demand being redirected into other markets. They know shorting silver here is like stepping in front of a freight train, holding a paper sign that says, "Stop." That freight train is global demand for hard assets. And if you stand in front of it, you don't get rich, you get erased. This tells us something else too. Any weakness we're seeing right now isn't natural selling. It's pressure from a handful of bullion banks, dumping contracts to keep prices contained, leaning on paper leverage to cap silver and defend dollar credibility. But they're alone. The rest of the financial world is standing back because they understand this $85 price isn't a ceiling. It's a coiled spring. And the moment that suppression loosens, arbitrage wakes up and the price can gap violently higher. We also need to talk about the oil side because it's connected to silver in ways most people miss. China didn't only suspend the silver fund, they hit 4 oil-focused funds at the exact same time. That coordination is the tell. And on the same day those suspensions hit, Brent crude broke above $70 a barrel for the first time in 5 months. While U.S. naval vessels were positioning near Iranian waters, the market was pricing geopolitical risk directly into energy. Chinese investors chased it through oil funds the same way they chased silver. Here's the loop regulators were trying to break. Tensions rise, commodities rise, retail chases, premiums expand, premiums become unstable, regulators intervene. But here's the part nobody wants to say out loud. That intervention treats the symptom, not the cause. Tensions are still there. Supply vulnerabilities are still there. Demand is still there. Halting trading for a day doesn't remove those forces, just compresses them temporarily. That's why I believe the oil story isn't close to done, and why it validates the precious metal story. Both are being driven by the same underlying force: loss of confidence in paper systems and a flight into physical assets. Think about what oil and silver share: strategic importance, essential industrial use, vulnerability to disruption, and paper markets where contracts massively outnumbered physical delivery capacity. When stress hits those systems and demand surges faster than supply can respond, people start questioning whether their paper exposure will actually convert into physical reality when it matters. That's when premiums explode. That's when funds trade 36% above NAV. That's when regulators panic. But shutting down trading doesn't create more oil. It doesn't create more silver. It just hides the supply crisis behind regulatory curtains. And here's what comes next. Pressure builds. Demand finds new routes. Premiums pop up somewhere else. Hong Kong, Singapore, London, wherever capital can move. We're already seeing it in physical premium data, in the gold-silver ratio compression, in the refusal to short even when headlines scream chaos. The smart money understands what regulators don't want to admit. You can halt trading, restrict purchases, impose cooling off periods, but you can't suspend the forces driving demand. And you can't manufacture physical supply with paperwork. So when I look at China's intervention, I don't see the end of the commodity rally. I see confirmation that the rally is strong enough to threaten systemic stability. And that tells me we're not near the top. If we were near the top, regulators wouldn't need to intervene. Weak hands would be selling naturally. Premiums would compress on their own. The market would find balance without emergency measures. The fact that they shut down trading twice in 8 days tells you the opposite. Demand is so relentless that normal mechanisms can't handle it. And when normal mechanisms can't handle demand, demand doesn't disappear. It gets more creative. Now, let me address the elephant in the room. I know some of you are thinking, okay, silver has momentum. Fundamentals support it. China's halt shows real demand pressure. But markets that run this hard, this fast, can also correct sharply. You're right. The same volatility that creates 58% gains in a month can create a 30% drawdown in a week. Some analysts are projecting $150 silver within 3 months. That might happen. But that's also the kind of aggressive target that tends to appear when retail enthusiasm is peaking. I'm not saying sell everything. I'm not saying the rally is over. I'm saying understand where we are. The easy money has been made. The obvious trade has been executed. What comes next requires more discipline, more patience, and more risk management. If you're already positioned, this might be a time to focus on protecting your downside rather than adding at extended levels. If you're not positioned, this might be a time to wait for pullbacks instead of chasing momentum at 52-week highs. Real wealth in these markets is built by the people who buy fear and sell greed. And right now there's a lot of greed in silver. That doesn't kill the bull run. It just means the next phase requires more skill than the first. But here's what I want you to understand about China's intervention. This isn't the end of the story. It's the beginning of a pattern. When markets get hot enough to threaten stability, regulators step in. They halt trading. They restrict new buys. They do what they think will prevent retail from blowing themselves up. That doesn't mean the trend is wrong. It means the trend is strong enough to scare them. And strong trends usually have more room to run once intervention pressure eases. History is full of this. Major precious metals bull markets repeatedly saw attempts to cool price action. The 1970s had multiple intervention moments. The 2000s run had similar behavior. Interventions created pauses, but they didn't erase the underlying forces. I'm not saying history repeats perfectly. I'm saying intervention during a strong bull market is normal. So if you're using China's halt as your reason to panic sell, you might be reading the signal backwards. Let me give you a framework instead of a prediction, because frameworks keep you alive in the volatile markets. 1. China's halt is a signal, not an endpoint. It tells you demand exceeded the system's capacity to process it smoothly. That demand redirects, builds pressure, and eventually releases. 2. Premiums are information. A 36% premium is the market screaming desperation and constraint. You don't need to trade the fund to respect what that premium is telling you. 3. Separate trading from accumulating. If you trade short term, don't chase. Wait for pullbacks. Don't pay a premium for exposure. If you're accumulating long term, volatility matters less. You're buying the decade-long thesis of debasement, industrial demand, and hard asset repricing. 4. Watch the physical market. When paper access gets disrupted, physical becomes more attractive. Dealer premiums are information. Rising premiums tell you the physical market is tightening. Falling premiums tell you supply is catching up. And right now, the physical market is screaming. Dealers are reporting demand patterns that look like panic buying. 158% growth in 1-ounce coin sales, 550% growth in 1 kilo bars. This is happening at the same time China is blocking paper excess. That means some capital is being forced into channels that are harder to suppress. Physical metal doesn't have trading halts. Physical metal doesn't have a fund manager who can block your buy button. Physical metal is the escape hatch. That's why watching dealer premiums matters. When premiums rise meaningfully above spot, it signals the paper price is disconnecting from physical reality. It signals people are paying extra to secure real possession. We're starting to see that in certain markets. Not everywhere, not evenly, but the trend is forming. And if Chinese demand continues moving into physical routes, those premiums can expand further. That creates a loop. Regulators restrict paper demand, moves to physical supply. Tightens premiums, expand premiums, validate. The paper is artificial. Narrative, more people rush to physical. You can't regulate your way out of a supply crisis. You can't suspend your way out of demand. And you can't undo decades of underinvestment in mining while industrial consumption accelerates. 5. Watch the gold-silver ratio. It's one of the most reliable cycle signals in this sector. It's in a powerful reversion phase right now, and whether it continues or snaps back tells you a lot about where we are. Beneath all this volatility, here's what I think is really happening. This is a stress test of global commodity infrastructure. Geopolitics, monetary confusion, and structural demand growth are pushing markets beyond what they were designed to handle. China halting funds is one response. Other countries may respond differently. But the underlying pressure is the same everywhere. And pressure like this tends to produce the same long-term outcome: repricing. Paper assets that used to feel safe start to feel fragile. Hard assets that felt old school start to feel essential. Fiat currencies that felt stable start to feel experimental. Physical commodities that felt boring start to feel strategic. That's not a prediction for next week. That's an observation about where we are in a multi-decade cycle shift. The people who recognize these shifts early position for generational wealth transfer. The people who dismiss it as noise get left holding devalued paper. So here's my question for you, and I want to hear your thoughts in the comments. Do you think China's trading halt is a warning that silver ran too far, or confirmation that demand is so strong, even regulators can't contain it? There's no wrong answer, but your answer reveals how you're reading this moment, and that shapes your positioning. Drop your thoughts below. And if you've been navigating this rally successfully, share what's working for you. Real-world feedback from this community helps everyone watching. Let me leave you with one final thought. When authorities intervene, they're telling you the market has gotten strong enough to scare them. And markets scare authorities when something fundamental has shifted. The forces driving precious metals demand aren't going away. Debasement concerns aren't going away. Geopolitical uncertainty isn't going away. Industrial demand isn't going away. Central bank gold accumulation isn't going away. These are multi-year themes, not multi-week trades. And if you're positioned for the long game, day-to-day intervention noise becomes a lot easier to navigate. Here's one more framework to lock this in. Markets move in cycles, bull phases, bear phases, consolidation, breakouts. Inside those cycles, there are patterns. Regulatory intervention is one of them, and it tends to show up at specific points. Early in a bull market, regulators don't care. Moves are small, retail is low, no systemic fear. But as the bull matures, prices accelerate, retail floods in, leverage rises, regulators pay attention. They see premiums expand, they see chasing, they see risk stacking. Then they decide, let it run and risk a brutal bust or intervene now to contain damage. China chose intervention. They saw a 36% premium and basically said, this has gone too far. We need to protect retail from itself. That tells you where we are. Not early, the easy money's behind us, but not late either. If we were late, premiums would compress naturally. Smart money would short, and weak hands would sell into strength. But that's not what we see. Smart money isn't shorting. Physical demand is accelerating. The gold-silver ratio says silver still has room versus gold. And Chinese demand is already finding alternative outlets. That's the middle phase of a major bull market. The phase where volatility increases, intervention ramps up. Weak hands get shaken out, but the trend remains powerful. The people who build generational wealth are the ones who don't panic in the middle phase, the ones who separate noise from signal, the ones who understand intervention doesn't mean invalidation. China's halt isn't telling you to sell. It's telling you demand is strong enough to scare regulators. Don't confuse intervention with defeat. Don't confuse temporary halts with trend reversal. Don't let short-term noise steal your conviction when the long-term thesis is still intact. Chill guy here. Friday, January 30th, 2026. Silver is at $85.15. Gold is at $4,918. China just shut down their only silver futures fund for the second time in 8 days. Physical demand is exploding globally. The gold-silver ratio is at levels we haven't seen since 2011. And smart money is refusing to short despite the chaos. If this breakdown helped you see through the noise, hit like, subscribe, and share this with someone who needs to hear it. Stay sharp. Don't let intervention noise shake your conviction. I'll see you in the next one.